Financial markets are inherently unpredictable. Prices fluctuate due to supply and demand, economic factors, and investor sentiment. To analyze and forecast stock price movements, financial analysts and traders rely on stochastic models and Monte Carlo simulations. These methods allow us to explore thousands of possible future price scenarios, helping investors make more informed decisions. Why simulate stock prices? Simulating stock price movements helps investors and analysts estimate future returns, understand potential price trajectories, manage risk, assess the probability of extreme price drops, price derivatives, value options, and other financial instruments. Test trading strategies, evaluate algorithmic models under different market conditions. Common models for stock price simulation. There are several ways to model stock price movements, with Monte Carlo methods playing a crucial role in estimating uncertain future prices. Random walk model. The simplest approach assumes stock prices follow a random walk, meaning each price change is independent of past movements. This model assumes that prices move up or down with equal probability, making future movements unpredictable. Geometric Brownian motion (GBM). One of the most widely used models in financial simulations, geometric Brownian motion assumes that stock prices follow a continuous random process. Returns are normally distributed. Future movements depend on volatility and drift. GBM is the foundation for the Black-Scholes model, which is used in options pricing. Mean reverting models. Some assets, like interest rates or commodity prices, tend to move toward an average value over time. Mean reverting processes, such as the Ornstein-Uhlenbeck model, simulate these assets by pulling the price back to a long-term mean. Monte Carlo simulation for stock prices. Monte Carlo simulation is used to model thousands of possible stock price paths. The steps include: Step 1. Define parameters. Initial stock price, the current market price. Expected return, the average annual return. Volatility, the standard deviation of returns, representing risk. Time horizon, the duration of the simulation. Number of simulations, the number of possible price paths. Step 2. Generate random price movements. For each simulation, 1. Generate a sequence of random daily price changes. 2. Apply these changes to the initial stock price using a stochastic differential equation. 3. Repeat this process for thousands of potential stock price paths. Step 3. Analyze results. After running the simulation, average future price, the mean of all simulated prices, probability of loss, the likelihood of the stock dropping below a certain threshold, best case and worst case scenarios, the extreme values among the simulations. Example, Monte Carlo for stock price forecasting. Let's say we want to simulate the stock price of company XYZ over the next year. 1. Current price, $100 per share. 2. Expected return, 8% per year. 3. Volatility, 20%. 4. Time frame, 252 trading days. 5. Number of simulations, 10,000. After running the Monte Carlo simulation, the most likely stock price after 1 year is around $108. There is a 20% chance the stock will be below $90. The best case scenario predicts the stock could reach $150, while the worst case suggests it could fall to $70. Monte Carlo applications in financial markets. Monte Carlo methods are widely used in finance, including option pricing, valuing call and put options, portfolio optimization, simulating risk and returns for diversified portfolios, risk management, estimating value at risk, algorithmic trading, testing strategies in simulated market conditions. Challenges of Monte Carlo simulation. Garbage in, garbage out. Poor input assumptions can lead to misleading results. Computationally intensive, large simulations require high processing power. Real-world market behavior. Models assume normal distributions, but real markets experience black swan events. Conclusion. Monte Carlo simulation is a powerful tool for modeling stock price movements and financial risk. By analyzing thousands of possible price paths, investors can make better informed decisions in an uncertain market. While no model can perfectly predict stock prices, simulating different scenarios provides valuable insights into potential risks and rewards.